Hello, everyone, and welcome to the 20th Annual FDIC JFSR Bank Research Conference. We're glad to begin our celebration of 2 decades of research and 2 decades of collaboration with today's Fast Track session. We'll talk a little bit more about this tomorrow, but the final selections of paper presentations at the Bank Research Conference are made by the discussants for each session. The conference organizing committee and FDIC staff economists review each submission to the conference and select what they think are the most compelling papers and organize them thematically. These papers are then anonymized and sent to the external discussants for final selection. Of the 12 to 18 papers sent to each discussant, 2 or 3 are chosen and become the sessions that you'll see tomorrow and on Friday. Sometimes the discussants really like another paper, but it doesn't quite fit right into the session that they're assembling. Instead of leaving these high-quality papers off of the program, we combine them into this fast track session that we're about to start now. After all 6 presentations conclude, we'll keep this room open until 5:30 p.m. Eastern Time for Q&A. Please post questions in the Q&A panel on the right-hand side of your screen at any time, or use the raised hand feature after all of the presentations conclude. Please note to whom your question is being addressed. All written questions, whether answered or not, will be shared with the presenters at the end of the session. Directions on how to post questions can be found in the WebEx reference guide link that's provided in the chat. With that, let me turn things over to our first presenter, Hans.
So thanks a lot for having me, and so it's a pleasure to be able to present this paper over here in this fast track session. And so what I want to present is on banks and firms, evidence of a legal reform altering contract design. And so let me mention that this is joint work with Olivier de Jong and Nick Karagiannis. And so since Olivier is at the Belgian Central Bank, let me also put up this disclaimer. So what's the motivation for this research project? Well, as you probably all know, in many economies, small firms are important due to their role for economic growth. And we also know that small firms typically heavily rely upon bank debt for their external financing, and implying that small firms are often in a weak position relative to their bank, often also because they have only one single bank relationship and therefore they may be bank dependent. And so when you're talking about banks and firms, we know that banks and firms are entering financial contracts that are going to allocate the rights to the parties involved. And so these rights are going to determine financial flexibility, but also they are going to determine potential liquidation decisions of firms or continuation decisions of firms. And so the broad research question that we aim to address in this paper is, how do credit markets function when the law imposes limitations on the contracting space? And so what is going to be our Qsi Natural Experiment? So what we're going to do is we're going to exploit a Qsi Natural Experiment that is going to alter the contracting space of banks and small firms. And so in particular, what we're going to investigate is that there are going to be prepayment options going to be imposed in newly originated loan contracts. And these prepayment options have an exercise price of 6 months interest rate. So before this legal change, the loan contracts did not include such a prepayment option, implying that firms that when they wanted to repay, that they often had to face excessive costs to repay the loan early or to get the collateral released. And so the main research questions that we aim to address are twofold. So firstly, how do banks and firms respond to restrictions on the contracting space? And secondly, do banks try to mitigate the effects of the imposed legal change? And if so, does it happen uniformly across borrowers? So let me immediately jump into the empirical setting. And so we're going to focus on a legal reform which took place in Belgium. So there has been a legal change that came into law in the beginning of January 2014 for all new loans granted to small firms, so not larger firms. So the law was voted in Parliament at the end of 2013, and the reform has affected, let's say, loans under credit agreement, that is, term loans as well as credit lines. However, credit lines are economically unaffected. The reason being that with a credit line by design, You draw what you need, and you can repay and repossess your project as you wish. And also, credit lines typically have a floating rate loan or have a floating rate, and hence automatically benefit from any drop in interest rate. And so what we're going to compare is we're going to compare credit lines and term loans behavior for large firms and small firms before the event and after the event. So you can smell already here a difference in difference exercise. Oops. So what are our hypotheses? So we are having a number of hypotheses. The first one is on credit availability. So the first thing is that, in terms of credit availability, there are two potential forces. So on the one hand, the new law may actually decrease credit availability because now, since it's more difficult for a firm to commit itself to a bank, banks may not be willing to engage with the firm to the same degree. On the other hand, there is also the boot and tackle idea that the new law may increase credit availability because it might stimulate banking competition, and therefore the relationships may become more intense. More importantly, we are having a hypothesis which is related to credit composition and maturity. So what we are claiming is that banks mitigate the effect of the law by reducing the supply of the affected loans, which are the term loans, and increasing the supply of unaffected loans. So what we are expecting here is that there is going to be a credit composition effect, which is going to be more pronounced exactly where banks are having stronger bargaining power, that is, for firms with stronger relationship. And so this effect is going to be also more pronounced for longer maturity term loans.
5 minutes, Hans.
Yes, thank you. So we also have a hypothesis on collateral. So what we are basically claiming is that banks might actually aim to bind firms to them through other mechanisms, such as asking collateral. So the law somehow reduces their commitment, but banks may try to undo this. And for the sake of time, let me skip the last hypothesis. So the data we are going to employ very briefly, we're employing the data set from the Belgian credit registry. So the nice thing often in Europe and many other countries is that we have really very nice micro data sets which are providing us information about every loan that the bank is granting to every firm. So next to that, we have also financial accounts and bank financial statements. And so we're looking at a window of 1 year before the event and 1 year after the event. So what is our empirical methodology? We are going to employ a difference in difference estimation strategy, where we are going to focus on the growth of the different types of loans at the bank firm level as a function of a set of control variables. But most importantly, we are going to be interested here in the coefficient B1, which is for treated firms, that is, and so treated is a dummy variable, which is equal to 1 when a particular firm is subject to the new law, and it's going to be 0 otherwise. And so we are all having all kinds of fixed effects in there to try to control for firm demand. So what do we find? So this is the slide which is giving us the main results. And so in the column number 1, what you can see is the idea of the overall credit availability. And so what we are finding is that treated firms, so the smaller firms which are subject to the law, that the reform for the treated firms increased overall credit growth by around 2.2% relative to the larger firms. In terms of credit composition, this is columns 2 and 3. What we are finding is that indeed we see a shift, that is a move away from term loans. So we see less term loans in column 4, 6%, whereas we see an increase in credit lines. So we see that, there is a credit composition effect in favor of credit lines and to the detriment of term loans. And finally, in terms of the fifth column, what we are seeing is also that banks are asking more collateral. That is, they aim to bind firms to them by also requiring more collateral. So a natural question you may ask is, well, is this reform going to be priced? Okay, so now suddenly this prepayment option is included in the loan. Is it going to be priced? And so what we are finding here in the first column is that there is an average increase in the loan rate of around 1.7 basis points for treated firms relative to control firms. And we see that this increase materially stems from firms which are only having term loans. So it seems that term loans become more expensive because term loans now incorporate this prepayment option.
2 minutes.
Thank you. So then the last question we are investigating is whether this legal change, this reform, has generated real effects. So recall what we find is that somehow firms, small firms, are having less term loans available. So what we are seeing is that this also seems to translate into negative real effects in the sense that we are seeing a drop in fixed assets of around 2.9% and also a slight drop in total assets. So we also see that somehow the maturity structure seems to be detrimental towards, let's say, long-term investments. So let me conclude. So what we find is, or what we are examining in this paper, are the implications of a legal reform that puts a limitation on the contracting space between banks and firms' financial contracts. So while we find a positive effect on overall credit availability, banks seem to mitigate the impact by increasing interest rates on term loans and by shifting credit towards the economically unaffected products, being credit lines. And so this credit substitution seems to be more pronounced among firms which have longer relationships with the bank and also firms that have relatively few outside options. So overall, what we are finding is that we are documenting, let's say, a knock-on effect, if you want, that is a relatively minor change, being this prepayment option, seems to affect several aspects of the lending decisions and not necessarily in obvious ways. So let me stop here. So thanks a lot for your attention and looking forward for any thoughts you may have. Thank you again for the opportunity.
Hi there. Right, so I am Alexandros Kondonikas, and this paper is joint work with John Cantras from the Fed and Sotirios Kokas from Essex Business School. So what we do in this paper is that we investigate the role of unconventional monetary policy, and more specifically the role of reserves injection by the Fed during the period of the financial crisis and its aftermath on US bank lending and risk-taking behavior using a sample of syndicated loans. So I mean the basic. Sorry, can you hear me now? Yep. So the basic motivation for our analysis is the idea that the role of reserves has been rather overlooked in recent analysis of quantitative easing, despite the fact that the huge rise in reserves has been the most defining characteristic of quantitative easing. Policymakers, central bankers were certainly very interested in the link between reserves and bank lending behavior. This quote here at the first bullet point comes from the memoirs of Bernanke, dates back just prior to the start of QE2, and the main gist here is that the Fed ultimately wanted these reserves to be channeled out to the real economy. When we conduct our empirical analysis, we face two main empirical challenges. The first has to do with a potential endogeneity between reserves and bank lending, which we address using an instrumental variable approach employing confidential daily data on reserves holdings by the US banks. And the second one has to do with the identification of the mechanism via which an increase in reserves is going to affect bank lending and risk-taking behavior. To tease out the mechanism, we utilize an exogenous regulatory change that took place in 2010 and fully implemented in 2011, and it had to do with the change in the FDIC insurance for the deposits, whereby the assessment base switched from a deposit-based insurance to an insurance based upon assets minus tangible equity. So this change affected the net return on holding reserves, and importantly for identification, some banks were less affected or not even at all affected by this regulatory change. The key findings from our analysis are that there is a positive link between reserves accumulation during QE and search for yield behavior by US banks, which is however weaker for the banks that are facing a higher net return on holding reserves. So in terms of the background, it was the Fed's response to the financial crisis that led to the huge rise in reserves. The bulk of the additional reserves are in excess of the regulatory requirements and receive interest since October 2008. There have been plenty of studies that exploit heterogeneity in the bank's holdings of QE eligible assets to identify bank lending effects of quantitative easing. The basic idea is that if you are holding more of whatever the Fed is going to buy subsequently, you are more exposed to QE. And there have been also studies that look at bank risk-taking effects of QE. Nevertheless, the vast majority of these studies tend to overlook the role of reserves. So this is where we come in, and we have this mechanism, the so-called reserves-induced search for yield, whereby the massive injection of reserves during QE suppressed interest rates and improved the economic outlook on one hand. On the other hand, it hurt the net interest income of banks, and these adverse effects on profitability, what we argue is that they can push banks into higher-yielding assets, fully in line with the search for yield mechanism as developed by Rajan and other authors in the past. Importantly, this mechanism is different from a simple positive mechanical link between reserves and lending as implied by the money multiplier. It does not depend on the type of assets that the Fed is purchasing, the identity of the sellers, and does not make any other strong assumptions in line with previous studies. And importantly, there is anecdotal evidence from official surveys of financial institutions which is offering support for this line of reasoning. So our data comes from the syndicated loan market. The primary provider is DealScan, whereby we get information on several loan characteristics, and we augment this data using information from the firms from the CompuStat and information from the banks from the call reports. The matching process yields about 8,500 loans over the period 2007 to 2016. This is the
5 minutes.
This is the baseline regression model. The key coefficient of interest is the lambda, which captures the interaction between the QE dummy and the changes in reserves over total assets. The QE dummy is equal to 1 during the specific episode of quantitative easing that we are interested in. We control for several other loan, firm, and bank characteristics and a rich specification of fixed effects. And as I said, the key variable of interest here is the change in reserves over total assets during QE. And as we can see in this diagram here, indeed, most of the activity in the reserves over total assets is taking place during periods of QE, and the variable is rather inactive outside the QE windows, which is in line with our identifying assumption. So these are the estimates from the simple fixed effects models. The dependent variable is the loan amount, and the key finding here is that there is a positive and statistically significant link between the loan amounts and the changes in reserves over total assets during periods of quantitative easing, with effects tending to be stronger during the second and the third round of QE. And importantly, these results are robust across different fixed effect specifications, starting from simply year fixed effects to to bank times year, to firms times year, to control for supply and demand factors, and also to controlling for potential relationship lending and other type of bank firm unobservable characteristics as captured by the bank times firm fixed effects. So moving on now to the instrumental variable approach. We use confidential data on the bank level daily reserves, and what we've done is that we regressed the changes in the bank level daily reserves on the changes on the aggregate reserves. The latter are controlled by the Fed's actions and they are exogenous to the bank, and we get this beta over each quarter from our estimations, and we use this high frequency beta, this high frequency sensitivity of bank level reserves to generate an instrument which is going to be the predicted quarterly changes in the bank level reserves. And the basic idea here is that the instrument, when it's varying, it's mostly varying due to client activity as opposed to strategic choices by the banks. So these are the estimates from the IV. The main findings from the second stage support the idea that replacing the actual reserves with the predicted reserves does not invalidate our previous findings. So indeed there is a positive and statistically significant link between changes in reserves over total assets and bank lending behavior during QE windows, tending to be stronger during the second and the third round of QE. And finally, moving on to the analysis of the mechanism. The FDIC proposal came about in November 2010, and the basic idea is that the assessment base for the calculation of the insurance fee is going to switch from the traditional deposit-based assessment to an assessment base which is equal to the assets minus tangible equity. Importantly, at that point in time, before the FDIC proposal came about, banks hoped that reserves are going to be granted an exemption because banks already had accumulated a lot of reserves due to QE. Nevertheless, only some banks were granted exemption, and crucially for our sample, it was the banker banks and banks with custodial business that received a partial exemption. So what we did is that we calculated each bank's exemption share, excluded assets over the total assessment base as of 2010 Q2 in order to avoid the anticipatory behavior. So then we moved on to these triple interaction models, whereby the key finding here is at the blue shaded lines here, where basically the idea is that the banks that are enjoying a higher exemption share, in other words, they are enjoying a higher net return on holding reserves, they are exhibiting a weaker link between reserve accumulation and loan amounts. So this is in line with a prediction from the reserves-induced search for mechanism, whereby the effect is going to be weaker for the banks that are enjoying a higher net return for holding reserves. So
1 minute.
We did a variety of additional tests. The most important test was, I would say, this test on risk-taking. So what we find is that not only there is more lending, but there is more lending to firms that can be characterized as riskier, both in an ex-ante and an ex-post dimension. And a variety of other tests that, if you are interested, please have a look at the paper. So to conclude, in this paper, we investigate the role of reserves in the transmission mechanism of unconventional monetary policy. We show that the reserves accumulation during QE led to higher bank lending and risk-taking in line with reserves-induced search for yield mechanism. The effect is attenuated by banks with larger exemption shares from the FDIC regulatory change, and we conclude by arguing that monetary policymakers and financial regulators should pay attention to the potential interaction between monetary and regulatory policy. So, thank you very much for your attention.
Thank you very much to the organizers for allowing us the opportunity to present our work in this conference. This is joint work with Darrell Duffy at Stanford and my colleague Yishao Zhu. If you look at the lot, and I have to go, okay, there we go. If you look at the first plot here, you observe that in the decade after the JFC, credit spreads of the largest banks in the US remained elevated. For example, at the end of our sample in 2019, credit spreads for the largest banks are still about twice as high as they were prior to the GFC. When you think about the reasons for credit spreads being higher, you generally have a number of sources for explaining this observation. For example, they could be higher simply because insolvency risk of banks has increased. Or they could be higher because investors in credit markets, and specifically those investing in big bank credit, have become more risk averse. Or they could be explained with lower expected recoveries at insolvency. Also, credit market liquidity may play a role. So what we want to do in this paper is to kind of give some understanding of what of these potential explanations contribute to arguing why credit spreads have not just increased during the JFC, during the 2011-2012 period, but have remained at these elevated levels post-JFC for largest bank. So first we're going to check whether or not these elevated credit spreads for large banks are simply due to an increase in insolvency risk. If you look at this chart though, and we have a number of others that tell a similar story in the paper, you see that this is a difficult argument to make, though, because measures of insolvency risk generally indicate an improved capitalization of the largest banks post-JFC. This figure here in particular shows the ratio of tangible equity to assets, both before in red and after the JFC. For the 6 GSIBs that we have credit pricing data for readily available. And you see that for all of these banks, these are your usual suspects, Goldman, Morgan Stanley, Citigroup, Bank of America, JP Morgan, and Wells Fargo. For each and every one of them, you see that solvency measures show an improvement post-crisis. So you can look at others, they tell a similar story, so you kind of have to rule out the explanation that credit spreads are higher due to a higher risk. In fact, the sort of observation of the higher credit spreads becomes even more startling given that measures of insolvency risk have generally declined. Solvency has improved for the largest banks. Similarly, we check by comparing the pricing of credit for large banks versus other corporates, whether or not the higher credit spread can simply be explained by market-wide changes in default risk premia or by market-wide increases and persistent increases in credit market illiquidity. And neither one of these potential alternative stories is sufficient to explain the increased level of credit risk pricing for the largest bank. So what we do is we focus our attention on expected recoveries at default. And what this graphic shows here is the impact of potential government intervention once a bank reaches insolvency risk on the pricing of credit, the value of debt issued by those largest banks. So in this graphic, it's very simple, but it shows a bank that has reached insolvency. And this is visible by the fact that the assets in place, the level of assets in place, is insufficient to pay back in full both types of creditors that we consider in our model. Those are depositors and bondholders. So if at insolvency, the government intervenes, potentially by injecting additional bailout capital into the bank, it has the ability to limit losses to senior creditors, completely eliminate them, but for sure limit them. So it can inject capital that is sufficient to pay back bondholders. However, if at insolvency the government is not intervening and you proceed to a failure situation for the large banks, then bondholders face losses. Now, failure of a large bank may be in the form of bankruptcy, as we observed in the case of Lehman, or in the form of bail-in of junior debt. The figure here focuses on the case of bankruptcy, where an insolvent bank basically faces distress costs that further lowers the available asset levels that can be distributed to creditors. And you see that bondholders in this case, of course, face a substantial loss, and the expected recovery at default is much smaller than notional. In the case of bail-in junior debt, this also involves a below-par recovery of senior bondholders. And so what we are interested in basically is to take financial reporting data and pricing data on market equity and debt for the largest bank to back out the likelihood that investors seem to assume of government intervening once a bank reaches insolvency. And we call this probability of government intervention pi, and the probability of no intervention 1 minus pi. And so what we do is
2.5 minutes.
Yeah, we propose a dynamic structural model of the valuation of bank assets and claims to bank cash flows. And that model allows for the possibility of bailout at insolvency, and it models the life of the bank after bailout and allows for potential future bailouts after the first one. We then take this model and calibrate it to, as I said, financial reporting data and market pricing data. And what we do find is that the probability of no bailout, no intervention at insolvency has roughly doubled in the post-JFC period. So that means that once you control for the solvency risk of banks, once you control for market-wide potential changes in default risk premia from prior to post-JFC, credit spreads are now roughly twice as high than they would have been in the pre-crisis period. So this is the first main result. Our framework also allows us to compute other comparative statistics. For example, we can quantify the impact on the market equity valuation that government support has. So if you think about the hypothetical scenario where GSIB bailout probabilities would have been as low before the crisis than after, then we can compute within our framework that GSIB equity market values would have been roughly half of what they actually were. So half of the market equity value could be subscribed pre-crisis to higher expected likelihood of government intervention at insolvency. And then we break down these 53% that we estimated into the portion that is due just to the increase in debt financing costs stemming from lower expected recoveries at insolvency. Assuming that the banks keep their insolvency thresholds, their default strategies the same. So of the 53%, 20% in this market equity reduction can be assigned to that. And the remaining 33% we find to be due to the optimal reaction by GSIBs to reduce bailout probabilities, which of course incentivizes them to default earlier, right? They no longer wait longer to enjoy the potential benefits that come with government support.
Anya, can you conclude, please?
Sorry?
Time to conclude, sorry.
Yes. So what we find is basically a large post-JFC reduction in market implied probabilities of bailout. These reductions are associated with big increases in debt financing costs for large banks, even after controlling for insolvency risk. We find that post-JFC, large bank creditors appear to expect to suffer much larger losses in the event that the GSIB approaches insolvency. And in this sense, we estimate a significant decline in too big to fail. Thank you.
Okay, thank you for having me. I'm Martin Oemke from the London School of Economics. I'm going to be talking about some new work that I'm doing with Marcus Opp on green capital requirements. We're motivated in this paper by the observation that climate change has become a big topic for central banks, financial regulators around the globe. I have a couple of examples on the slide here from the ECB strategy review, the Bank of England Future of Finance report, but obviously also in the US. This is something that's being discussed. And it's also something that I think remains controversial in the regulatory sphere, also more broadly. And so the objective of this paper, this is a theory paper, is to think about these issues in the context of bank capital regulation. And what we're trying to do is, on the one hand, look at some positive aspects, meaning just thinking about what are the effects in equilibrium if capital requirements were to condition on whether a particular firm is brown or green or exposed to climate risk. but then also go down a little bit more of a normative route and ask, well, what about optimal policy? And how would optimal policy depend on different regulatory objectives, whether you stick to what you could call a classic prudential mandate, where you think about the safety and soundness of the banking sector, say, as a bank capital regulator, or if you want to take a broader view where bank capital regulation becomes a tool to potentially even address carbon emissions directly, something that we'll call a green mandate. So let me just quickly say what the high-level takeaways are, and then I'll tell you a little bit about our analysis. And I'll phrase them in questions here. Question number one is, can conditioning capital requirements on being green or brown address climate-related financial risks in the banking sector? And here our answer is yes. But the qualification is that doing that is not the same as lowering carbon emissions. So these are distinct objectives, and I think it's useful to be clear about that. The second question is whether capital requirements could be a tool to help reduce emissions, for example, in the absence of a carbon tax. Here, our answer is much more qualified. Sometimes the model says, but actually the firepower is quite limited. And you may have to, as a regulator, sacrifice your financial stability goal in order to do so. So our model gives less support for capital requirements as a tool to directly address emissions. And then finally, the model, and I won't focus on that in the 10-minute session, can tell us a little bit about whether you should be raising requirements for polluting firms or decreasing them for clean firms, the brown penalizing versus the green supporting factor. I won't have time to go through the model. Let me just tell you what goes into it, and then I'll tell you in words what the results are. So this is a kind of a typical banking model, single period, risk neutral. There are some firms, a continuum. Some of these are dirty, some of these are clean. Those attributes are given in this model, so firms are born either as clean or dirty. They can invest. There are risky cash flows that they generate in the future. And as our baseline scenario, we look at one where the dirty firms are financially more profitable, say looking backwards, in time before climate risk became an issue. Maybe it captures that type of a baseline scenario, but they generate higher emissions than clean firms. And those firms can then go to a continuum of competitive banks, raise financing there. The banks maximize the value of the equity, and they can raise deposits. The friction on the banking side is that there's deposit insurance, but that's not perfectly priced, kind of the typical way that you get a role for capital requirements in a lot of the theory models on bank capital regulation. And then the final ingredient is a bank capital regulator who sets capital requirements. And those capital requirements, and that's the key thing, could be distinct for the clean versus the dirty firm. When they change capital requirements, of course, they're going to affect the deposit insurance put, and they're also going to affect in equilibrium which firms are going to receive funding. So let me highlight what comes out of first the positive analysis and then the normative analysis, and then I'll summarize. The positive analysis essentially tells us that when we think about changing capital requirements for, say, clean or dirty firms, one useful way to think about it is in terms of income and substitution effects. Let me pick one example, the brown penalizing factor, so raising a capital requirement for, say, a polluting firm. What's going to happen? Well, the model shows that on the one hand, you're going to have what looks like a substitution effect. It's now, relatively speaking, cheaper to fund the clean loans because relatively they have a lower capital requirement now. But there's also an income effect. Because you've raised the capital requirement for the dirty firms, banks in total, if they fund some dirty projects, can afford to fund fewer loans of both types. And the key thing here is to think about, how big are these effects relative to each other? And one of the things that's quite possible, actually, is that when you raise the capital requirement for the dirty firm, what you actually do is crowd out some of the clean lending. It's possible that the dirty firms are still profitable at a higher capital requirement, but at the margin, you actually crowd out the clean loans. And so I think the high-level takeaway, this was one example, is that when you consider these policies, you need to think about both of these effects, income and substitution effects.
4 minutes.
We then move to optimal capital requirements, and let me highlight briefly first the, say, more classical prudential regulator, and then a regulator that also directly targets emission, what we call the green regulator. So the prudential regulator is going to maximize a trade-off or solve a trade-off where, on the one hand, you want banks to fund firms to generate NPV. On the other hand, the deposit insurance put results in a net cost, in a deadweight cost. And we can solve for optimal prudential requirements and then ask, well, how does climate risk enter this? And it's going to enter, if you're the prudential regulator and the objective is the one that I have on the slide here, well, it's going to have to either enter through NPV or through the deposit insurance put, so through the financial characteristics of what banks are funding. One example that I want to highlight here is transition risk. So how can we think, for example, in this model in a simple way about transition risk? Well, suppose a carbon tax might come into effect down the road, or consumers may not buy from polluting firms anymore. That's going to lower the profitability and or increase the risk for the dirty firms specifically, or more than for the clean firms. And so in that case, what the model would show is that, well, what you want to do then to continue to maximize your prudential objective is to increase the capital requirement for the dirty firm. A Brown penalizing factor becomes optimal now. And the interesting thing is this crowding out of clean loans that I mentioned earlier on as part of this income versus substitution effect is actually something that you may want to do. You may, as a regulator, say, well, I would like a higher equity cushion. Some stuff gets crowded out at the margin. This could be clean firms or it could be dirty firms. In fact, you're going to have to think about the third bullet point here about, what do you want to do? Do you just want a higher equity cushion, just absorb losses? Or do you actually want to influence who gets funded and push out some of the dirty firms because they've become very risky? And so that's going to depend. Which of these is more important, going to depend on the size of the climate risks. You could do similar experiments. I've highlighted here transition risk, but you could also think about physical risks, for example, hurricanes or flooding that symmetrically affect clean and dirty firms. Or you could even think about endogenous risks, where the emissions that are caused by the firms in this model then influence the risk characteristics of firms. Now, the last thing I quickly want to talk about is this broader green mandate. In other words, what if we were to try to use capital requirements as a tool to actually lower emissions? This type of a regulator still has, as a first part of the objective, the prudential mandate, NPV minus the deadweight cost of the deposit insurance put, but now also cares directly, it's highlighted in red here, about the carbon externality. And I want to focus one example that I think makes clear what the difficulty with doing this is. Suppose we've identified some firms that generate very large externalities. And so now, as a regulator, because the externality, the red term here, enters our objective, we may not want these firms to be funded at all. And our tool, the capital requirement, the question then is how effective is it at reaching that goal? And here, our model shows that capital requirements are likely not the most effective way to do this. And the reason is that as you raise the capital requirements for dirty loans, those loans might remain profitable from the bank's perspective to fund, even at relatively high capital requirements. And so if you really want them not to be funded, you may, at the same time, as a regulator, have to distort your clean requirement, lower the clean requirement in order to get the banks to prefer funding the clean loans. And in doing so, you will have to sacrifice part of the other part of your mandate, the financial stability or prudential part of the mandate. And so this shows, in our view, that if you contrast this, for example, with the carbon tax, of course, the first thing that would come to an economist's mind dealing about these issues, if it weren't for, say, political economy constraints, you wouldn't have these issues with the carbon tax, because there you can directly affect the profitability of the dirty projects. If you do it the roundabout way through capital requirements, you have to jump through more hoops in a way and sacrifice more of your other prudential mandate. So let me conclude.
Thank you.
Oh, one too far. Let me conclude. What we try to give you is a flexible framework to think about various dimensions of green capital requirements. We have a positive analysis. What would Brown penalizing factor or green supporting factors, I didn't focus on that in this talk, do to the equilibrium, and then a normative analysis in terms of both prudential regulation and a broader green regulator, where the takeaway is that prudential regulation is actually likely quite effective at dealing with climate-related risks, but directly reducing emissions through bank capital regulation is likely to be more difficult. And so here, for example, a carbon tax is a more direct tool to do that. Thank you very much for your attention.
So I'm next. So my name is Ricardo Correa. I work at the Federal Reserve Board. And first, I want to thank the organizers for adding our paper to the program. This is joint work with Sumit, Bernardo, Jessica, and Claudia. Given that some of us work for government institutions, I have to give you the typical disclaimer. These do not represent the views of necessarily the views of the Bank of Mexico, the Board of Governors, or the World Bank. So what do we do in this paper? So in this paper, what we want to analyze is what's the effect that a bank large exposures may play in amplifying shocks to particular industries. And we're going to hint a little bit at what is the mechanism through which those shocks could be amplified. So we know that large exposures to individual borrowers or connected borrowers are risky for banks, and the Basel Committee on Banking Supervision has established regulation to try to prevent those large exposures from taking place. However, you can have scenarios where the banks are exposed to borrowers below that threshold, but you are exposed to many borrowers in the same industry, and that may generate some negative consequences for the bank and then for the economy if there's a shock to that particular sector. So why do we care? Because this shocks to these particular industries may trigger amplification mechanisms elsewhere, so the banks may stop lending to borrowers that are not directly affected by the immediate shock. So what do we do specifically in this paper? We focus at the large drop in energy prices in 2014, and we're going to focus on Mexico because we have good data for Mexico. In 2014, very briefly, there was a large drop in energy prices. On the right-hand side, I'm showing the drop in oil prices, for example. It dropped dramatically in the middle of the year. It was a combination of both supply factors, so more fracking in the U.S., and also demand factors, so less demand for oil and energy products around the world. So what did that generate? That had an impact on energy producers. So the other two lines there, the dashed line and the dotted line, shows the CDS premiums for energy producers in both Mexico and in emerging markets. And you see the large increase in CDS premiums for these borrowers. Mexico is also a nice case because they have controlled energy prices. So the energy prices, the drop in oil prices did not translate into cheaper energy products elsewhere because of this price control. So we can focus on the effect directly on the energy sector. So again, the broad question is, how do banks react to these large shocks to an important fraction of their portfolio of the large borrowers? And in particular, I mean, I think our contribution in this paper is to try to provide a mechanism or some evidence of a mechanism that may drive this amplification effect. And we pose in the paper that bargaining power may play a role. So if you're exposed, you have large exposures to a sector that's in trouble, your bargaining power with those borrowers may decrease. As a bank, your bargaining power decreases, and you may be forced to lend more to these borrowers in these periods of stress, with consequences elsewhere in the economy. This sort of complements the work of Janetti and Saidi, which focus more on how banks internalize specific spillovers that may impact, or the spillovers that may be generated by shocks to specific industries. So let me go straight to the data. So we have access to the credit registry for Mexico. So we have millions of loans for 18 banks, and we focus on the period between January 2013 and June 2016, which is the window in which this energy price collapse happened. So here I'm going to show you some aggregate evidence of what happened at that time. So we split the banks between those that have exposures to the energy sector above the median and below the median. The above the median banks are the ones in red. So let's start with on the left chart with the bank exposures to the energy sector. We see that when the shock happened, these banks actually lend more to the energy sector. Lend much more than the control group, which is the banks that have the lower exposure. How did that translate into CDS premiums or equity prices for those banks? As we see in the middle graph, CDS premiums for the banks with the large exposure to the energy sector increased by more, and equity prices decreased by more. So it did have negative consequences for these banks in terms of market pricing. So let's go to. Thank you. Let's go to the micro level evidence. So here we use the loan level information to try to see whether banks with largest exposures to the energy sector as of August 2014 increased or decreased their exposures ex post, so post September 2014 to this sector. And we use a plethora of fixed effects to try to control for confounding effects. So what do we find? Indeed, these banks with large exposures increase their lending to the energy sector by more. They increase lending for working capital. It makes a lot of sense because the cash flow for the borrowers decreased, so they had to finance that working capital. Nothing happened to investment. What was more surprising was that the loan terms became looser for these borrowers. So banks with large exposures actually decreased the interest rates charged to borrowers in the energy sector. They also extended the maturity to these borrowers. So they provided more lending, but at looser terms. So this hints to that bargaining power dynamics. So the next question is this zombie lending? I mean, are these banks capital constrained, so they have to provide more lending at looser terms because they're in bad shape? Or is this bargaining power? So does the bank have weak bargaining power and they cannot prevent themselves from lending more to this energy sector? We find evidence for the latter. So it's actually the bank with the higher capital ratios, the ones that lend more to these borrowers, both for on aggregate and also for working capital purposes. So it points more to this bargaining power story, where banks with the higher capital cannot blame or bring the regulator or the supervisor to as an excuse to lend less to these borrowers.
2 minutes.
Perfect. So do we observe spillovers elsewhere? So let me start with lending to non-energy sectors. So what we find is that lending to the non-energy sector actually decreases overall. Lending for working capital decreases on aggregate, and also more strongly investment as well. So there are spillovers, and there are spillovers particularly to small firms, as seen in columns 1, 3, and 5. So the small firms are the ones that suffer from this additional lending to the energy sector. We also find that there are real effects. So at the firm level, we find that firms that are located in municipalities where banks are exposed to the energy sector, they have lower working capital after the shock. They invest less. They have lower liabilities and lower assets. And also states that host more banks exposed to the energy sector, those states have lower GDP growth, especially in the manufacturing sector. So to conclude, so what we find in these papers are three broad results. First, exposures to a particular industry, in this case the energy sector, may lead to an increase in bank lending to that sector when the sector is in trouble, and to looser terms. And we claim that this is due to lower bargaining powers for the bank. And this is part of the evidence is the one I showed about the bank capital, where banks with the higher bank capital are the ones that they provide more lending and at looser terms. And we find that this type of shocks and the amplification mechanism can generate problems elsewhere in the economy, both at the firm level and at the aggregate state level. Thank you.
Hi all, I'm trying to share my slides. I'm going to do this right now. Okay. Can everybody see the slides? I hope so, yes. All right. So this paper is joint work with Sumer Atmaka from Ghent University, Steven Ongena from Zurich, and Caroline Kirschelman from ZEW. What we're going to do, we're going to take a look back at the Great Financial Crisis, and basically we're going to have a look at how the initial actions that governments took to basically restore confidence of the depositors, how these actions really worked and how successful they were. Because, of course, there has been an avalanche of actions. There have been capital injections, there have been guarantees, there have been nationalizations, there have been increased deposit guarantee schemes, and later on there have been repayment of these capital injections and reprivatizations. What we want to do is we want to look at the conjoint effects of these actions, because sometimes it's not very clear whether the effect is due to the increased deposit insurance, due to the nationalization, or due to the later reprivatization. And you basically want to have an understanding of the joint effects. For that purpose, you're going to use anonymized data, individual deposit data of a large European bank. Basically, we have two research questions. The first one is going to be, what is the heterogeneous impact on depositor behavior of three government policies that happened in many countries, and especially in Europe? First one would be the increasing of the deposit insurance coverage limit. Second one is bank nationalization, and the third one is bank reprivatization. And these policies did not happen separately. They happened jointly. Of course, you cannot nationalize and reprivatize jointly, but in both cases, there were combinations with increased deposit insurance. And we want to understand these effects. The second research question is, are these effects actually moderated by, first, the strength of the bank's customer relationship? You could imagine if there is a strong relationship between the bank and its customer, that person is less likely to run in the first place. And because of that, you expect less effect of the government interventions. The second one is, are these policies going to be affected by trust in the government? Because, at least in many countries, both the deposit insurance and the nationalization are, of course, strongly related to how much you trust the government. More specifically, we're going to look at Belgium. We're going to use data from a Belgian branch of a large European commercial bank that had a real bank run in the retail market at the moment of the Lehman collapse, was nationalized in 2008 and reprivatized in 2009. And Belgium did increase its deposit insurance limit before the rest of Europe already in November 2008. The data coverage are going to be more than 300,000 fully anonymized and randomized depositors in Belgium. For these people, we have monthly data covering the crisis and before and after. And you have also a lot of other variables on these people: individual, civil status, income, relation with the bank, data on the bank branch. Did the bank branch change name? Did they move? Did they have an account manager? And so on and so on. So we can control for quite a lot. The time number of events is as follows. We cannot put exact dates because of anonymity, of course, but there's not so many candidates it can be, but it's one of these, obviously. So the bank was private with the deposit insurance limits up to the crisis. Then there was very quickly a nationalization. And it became a state bank. with a deposit insurance of 20,000, then all at once deposit insurance was increased. And that happened in November 2008. And then there was a period where it was a state bank with a deposit insurance limit of 100,000. And then later on in 2009, it was reprivatized and it became a private bank with a deposit insurance of 100,000. So we have basically 4 states: private bank 20,000, state bank 20,000, state bank 100,000, and private bank 100,000. The fact that this deposit guarantee was introduced was very salient for Belgian depositors. It was all over the news, and I just give you a few headlines of large and important Belgian newspapers in both languages. And you see that the dates are like 18th of November, 20th of November, where they basically explain very clearly 100,000, 100,000, decrease of 20,000 to 100,000. So people knew about this very well. You can also see it if you look at Google Trends. If you look at Google Trends, you see there's a very big spike. I'm going to skip this. This is just saying that Europe did the same thing, increased to 100,000, but much later there was a European directive in March 2009 that became really totally valid only in 2010. Now, did something happen at our bank? Yes. Just look at the total deposits in billions. There was a run from 2.3 billion to 1.9 billion. So they lost 400 million deposits. So something was going on. But that run didn't quite happen for the insured ones, actually. So this should be from 10 to 20, not to 200, obviously. And you see there, it's also in billions. So there was a decrease from something like 68 to something like 65. So they lose, what is it, 40 million maybe. While the ones that are not insured, from 20 to 100, they had a much larger collapse of deposits of more than basically 200 million. So there is quite some variation. Also, if you look just at the distribution of where the depositors are, and we're looking around the 20,000 and around the 100,000, you see that before the increase of deposit insurance, there was already a little bit of bunching. After the deposit insurance, during the nationalization, you see that more people are at the 100,000 and 20,000 become less important. And especially when the bank is reprivatized, the deposit insurance becomes very important. And people are really a lot more likely to have exactly 100,000 in their deposit account. So that's interesting. So what we're going to do, our main specification is going to be a difference in different specifications. Since you have all these people over time monthly, we can do fixed effects. And basically what we're going to do is we're going to have a treatment. And the treatment is that your deposits that were not insured before the reform and became insured after the reform. So that would be the deposits from 20,000 to 100,000. And we're going to interact, so we have that as a treatment variable, and we're going to interact that treatment variable with also the other parts. So basically the other parts would be, we would integrate them with the state, the nationalization phase, that's the state dummy, and with the privatization phase, that's the private dummy. We get some results, but instead of going through all the results, they make a lot of sense. You see that the uninsured guys run, the less insured you are, the more people run. You see with all the states, variables and interactions, you see that basically coefficients turn positive or insignificant. So basically, once you nationalize, deposit insurance doesn't matter anymore. Once you're privatized, and then you have to look at a bunch of lines with private on top, you see that all at once the coefficients turn positive. So deposit insurance really starts to work once the bank is privatized again. So this is the actual treatment effect. So, but let me skip this because I basically over time, and that basically shows that it's really the effect during reprivatization. What you want to see is the effect stronger if the relationship is stronger? And the spoiler alert is yes. What we're going to do is we're going to have 4 measures of relationship strength: the scope, in how many the bank domains the customer is active, whether he has a mortgage with the bank, the number of products he has, and whether he receives his main income or her main income at the bank. I'm going to show you 2 results, and I'm going to just show you the figures. So this is scope. So here you have 2 panels. It's the nationalization period panel and the privatization panel. The blue is the treatment group, and the black is the control group. In both cases, you see 3 things. You see, first of all lines are going up. So the more scope you have, the less people run. That makes sense. The second thing that you see is that the blue lines are flatter than the black lines. That means for the insured group, for the treatment group, that is receiving deposit insurance, in both cases, scope plays less of a role. So the ratio plays less of a role if you are insured. And third, you see a shift. The black line stays in place while the blue line jumps up from left to right, because on the left side, it starts at 0. At the right side, in the privatization period, it starts at a growth of 2%, moving up to 4%. So you see that indeed the scope, the relationship matters a lot. The same you show with mortgages, that's a yes or no, and exactly the same effect and the same logic. The last thing we want to know is it related to trust? And we're going to measure trust by the canton level share of valid non-blank votes in the federal elections of 2007. And this is very cool because in Belgium, you're obliged to vote. So people, if they exert some effort to come to the election, to vote blank, it really reveals distrust. And we turn this into a variable that measures distrust at the cantonal level. And we interact this with our main effect to see whether it depends on trust. And this is what we find. We see that during the nationalization, trust does not matter so much to disentangle the deposit insurance versus the not deposit insurance group, so the treatment versus control group. But once you reprivatize, you see that the blue line, if you go from 0 to 1, from low to high trust, you see that if there's low trust, it doesn't matter whether it's deposit insurance or not. But if trust increases, you see that the blue line significantly grows out of the black line. So basically saying that deposit insurance is successful in reattracting deposits to the bank, especially in those places where people trust the federal government.
And can you wrap up, please?
Yes. So there's also some bunching between 20,000 and 50,000, but this is my last slide. So basically what we find that this deposit insurance reform and nationalization has been actually successful in restoring trust in banks. Deposits that have been more treated, have a larger increase, see their deposit growth increase more. And nationalization has worked across the board in calming all depositors. And once coverage is increased to 100K bunching starts happening, and 20K bunching disappears. So people are going to sort just around 100. We also see that these effects are modulated by relationship and by trust. Captive depositors with strong relationships at the bank, they run less. And of course, they will also react less to deposit insurance changes and to nationalization. Trust in the government, on the other hand, boosts the effectiveness of federal initiatives like nationalization or increased deposit guarantee system coverage. So basically, in the end, what we could say we think we have found clear evidence that, first of all, depositors are very well aware of changes in bank ownership and deposit guarantee schemes, and they react rationally to these changes. Thank you for your attention.
Thank you very much to all of our presenters. We'll now open things up for the Q&A. You can enter questions in the Q&A panel on the right-hand side of your screen. You can also use the raised hand feature in the participants list. It looks like a little hand like that. I'll open by asking Cohen, if you're okay with it, to pose the question that you had for Martin. Not all the participants can see it, so I feel like that's a natural
Yes,
place.
I'm happy with that. Yes, okay. Yeah. So basically, should I repeat the question, or is it just a written version? That's okay.
Yeah, you can repeat the question since not everyone in the audience can see.
So my question basically was, okay, you have this discussion at the end that using capital requirements to reduce carbon emissions would come potentially at the cost of financial stability. And Martin made the argument that it's better to use carbon taxes for that it's more directly efficient. And I agree, we both agree on this. But then my follow-up question is, but if you do both at the same time, if the government effectively introduces carbon taxes on dirty firms, does that not basically change the logic? Because then these dirty firms become less profitable, and the mechanism in your model that makes capital requirements not work is basically that the dirty firms are still profitable enough. But if carbon tax take account of that, doesn't that not also the financial risk of also using capital requirements for reducing emissions, does it not basically disappear? Because the mechanics of your model is it's through the profitability. But if carbon taxes take care of the profitability of being dirty, does that not invalidate the arguments that you cannot use capital requirements?
Yeah, thanks, Karen, for your question. I think that's a really good question and clarification, because obviously in the 10 minutes, it's hard to go into all of the details. And so what I talked about, our main kind of scenario is one where the carbon tax, for some reason, say political economy, is not possible. And then we ask, well, if you were to just use capital requirements, how far could you get and how effective would it be? And so the point I made at the end of the presentation is that if your goal is to reduce carbon emissions via capital requirements, that might have to come at sacrificing your prudential mandate. And Kern's intuition is exactly right, so that if you now could introduce also a carbon tax, you could essentially separate these two problems. You could deal with the carbon externality via the carbon tax. And then, in fact, it wouldn't be necessary anymore for the bank capital regulator to think about the carbon externality. That would be done, say, via the environmental agency or whoever it is who puts the carbon tax in place. And so then there isn't a sacrifice necessary anymore on the prudential mandate. So the sacrifice really comes because you're trying to do two things with one tool in a way. And so if you have both tools, then you can deal with them separately. And so, yeah, that's a great point. And I'm glad we clarified that. Thank you, Grant.
And I see a hand raised from Chris Martin.
Thanks. So my question is for Ricardo Correa. In thinking about the sort of real effects of the oil price shock, how can I think about sort of disentangling the direct effects on the local economy of the oil price shock versus the pass-through effects from the banks and their credit decisions? So just sort of coming from the perspective that I'm guessing the banks tend to lend to local firms, and so the overlap of direct and indirect effects geographically would be pretty high. Thank you.
That is a great question. So at the aggregate level, one thing that we do is that in Mexico, I think there are 32 states and 2 are the oil producers. So we use the states that are not oil producers. So we try to remove ourselves from the direct exposures to energy production. So that's at the aggregate level. Now at the firm level, what we try to do is we try to look for locations where energy is not an important component. And as I mentioned at the beginning, I mean, one interesting feature about Mexico is that there are a lot of price controls on energy products. So energy prices did not change, even though there was a big decrease in global prices of these commodities. So that indirect effect sort of is controlled for that price controls that were established. So we expect that those firms that are removed from the energy sector are not going to have any direct effect. So anything that we observe probably is coming through the relationships with this bank that are in turn exposed to the energy sector. One thing that we haven't done is to try to see whether there are any supply chain issues. I mean, the energy sector is sort of like more or less concentrated. I mean, and we try to be as encompassing as possible, to try to exclude that from the rest of the economy. But I mean, if there are supply chain issues, we should perhaps control for that, and that's probably an area where we have to do a little more work. But yeah, I think our advantage are twofold. One is this price controls that help us to isolate the effect on the rest of the economy, and then looking at sectors or geographies that are far removed from the production areas in Mexico.
All right, great. I see a question from George Shukri.
Hi, my question is for Martin for the paper on green capital requirements. So in practice, it's difficult to tell which firms are clean and which ones are dirty. Lots of dirty firms might make claims to being clean and point to all the clean things that they're doing. So I'm wondering if there's some, let's say in the model there was some costly verification on how truly clean a firm might be. So I was wondering if you have thoughts on how that might affect the results. Would it just simply shift everything in the same direction? Or maybe it would tend to favor the dirty firms who maybe if they don't claim to be clean in the first place, then there's no verification that needs to happen for them. So I was just wondering if you have thoughts on that. Thank you.
Thanks for the question. My view, so I didn't have time to go through all the details. So the assumption that we make in the paper is that this is completely observable, so the regulator can see who is dirty and who's not. Of course, that's not a representation of what goes on in practice. There's a lot of debate right now about greenwashing, all these kinds of things, right? So it's, I think, important to think about, what does it mean for the interpretation of our model. What I would argue is that we essentially give the capital requirement. If we go back to Kuhn's earlier question about how effective, say, are capital requirements in actually addressing emissions. I think the model we've written down essentially gives capital requirements in a way the best shot. It's the best case scenario. You can actually identify which firms are clean and dirty. And also another assumption we have for tractability is that bank funding is the kind of only game in town. So the firms are bank dependent. They can't substitute to, say, the bond market, which is also something one could introduce. And so in a way, capital requirements, we're giving them kind of it's the best case scenario in a way, but nonetheless, the analysis shows that if your aim is to reduce emissions, capital requirements are probably not the best tool. And so my prediction would be, if we were to introduce these frictions in the model, for example, making it hard to tell who is clean and who is dirty, that would further take away from the ability of capital requirements to as a direct tool to affect emissions. It would also, of course, make it harder if we go back to just the prudential mandate in terms of risks, right? It would also make it slightly harder, I guess, to capture exactly where, say, the climate risks lie. I think there you could, work with a model where there's some sort of an informative signal and you base your capital requirement on that. But it's going to become less precise, of course. And so we're giving the best case scenario in a way.
Great, thank you. I see a question from Halem Anderson.
So I have a question to Alexandros. So Alexandros, you said because of banks built up so much excess reserves, now banks are using those reserves to lend to riskier projects, basically fund riskier projects. So what kind of policy would central banks use to discourage that? Do you think like higher requirements that can take that into consideration, or banks should central banks should increase reserve requirements, or maybe pay more interest on their reserves? Like, what kind of policy do you think central banks should use?
You're muted, Alexandros.
Apologies, yeah. So this bank risk-taking behavior has been well established in the previous literature. I mean, what we just do is that we just show that it can be contingent upon a regulatory policy. So, I mean, the results are actually showing that the banks that had less of an incentive to channel the reserves into lending are showing less of that. So, indeed, there can be regulation, can be a sort of tool that can allow this sort of risk-taking to be controlled. This is what is shown by our results. Yeah, I agree.
Thank you. Chris, do you have another question? I see your hand up.
Yes, thank you. I actually have a second question, or really a two-part question for Kuhn Schorz. Are you able to say anything about the deposit rates that this bank pays? I'm particularly interested in how they were able to attract so many deposits to sort of replace those that ran off so quickly. And sort of relatedly, are you able to say anything about the differential behavior of depositors that who had been at the bank for some time versus those who arrived during this period of stress? One can imagine that particularly during the privatization period, there might be depositors who would take advantage of the essentially unlimited deposit insurance and just show up at the bank fresh. Thank you.
Yes, thank you so much. For the prices are usually based on the product, and they didn't change much at all in that period. So it's not price-based in Belgium. About getting new people in and old people out, the sample is not balanced, so we could basically try to separate new and old people. We haven't looked at that. We have looked, of course, at a lot of robustness checks. So we have done our analysis with a balanced sample, and there it still works. Just if you cut out the people that come in and come out, the main results are still there, but you could also probably do the opposite, focus on these guys that come in and come out, and see what happens there. We also have access actually to more data in the same bank today, so we could revisit the raw data and basically not have a random sample, but have a specific sample of people that left and people that returned not in, and that would be maybe interesting to look at too, yes. So thank you for the question.
Actually, Cohen, I see that you have a question for Ricardo in the Q&A. Again, the attendees can't see it, so I'll let you try and pose it to the audience.
Yes, thank you. So Ricardo, I have a big interest in this political economy literature that basically says that there is something like a resource curse, and that basically argues in Brazil that a lot of the local communities in Brazil get a share of the oil revenues. And in times of oil bonanzas, when prices go up, what typically happens is that the local government spend more, but it doesn't always improve the welfare of the people because a lot of the spending goes to corrupt purposes. But that could, of course, also affect the local economy. This oil, political economy, oil cycle could affect the local economy. My question is, how can you disentangle this from the effect of what happens with the banks?
That's a great question. I mean, the advantage, again, that we have with Mexico is that most of the energy production is in two states, concentrated in those two states. So we exclude them from our estimations, at least when we look at spillovers elsewhere in the economy. And in Mexico, I mean, the oil production, for example, is highly concentrated, so that they have a national oil company. So if anything, that's going to be distributed across all the states in some way. But again, I mean, for direct effects of the oil bonanza or oil shock on particular states, we try to exclude those. So it would be like excluding Texas and North Dakota from the U.S. so that we can focus on states that are not directly impacted by oil price changes. But this is a good question. And I think there's some work on this area, looking at the oil price changes and energy price changes in Mexico and how that affects the local government. So, but we don't get into that. We just try to control as much as possible in our specifications. Thanks.
Thank you. Thanks.
And I see Martin has a question.
Yeah, I have a question for Antje Berndt. I mean, I thought it was fascinating, how you tried to tease out, the too big to fail element. And I can't quite remember whether it was all US data or whether you were also looking internationally. I mean, one of the things I'd be interested in is, for example, comparing the US to Europe, say, or whether it's even possible to look within Europe for different institutions. So just wondering, what you have tried or what you could do on that dimension.
Yeah, thanks. We are working on Europe in the background with another co-author, Ilya Dragunov, from SAFE and ANU. And for Europe, we are also extending to the estimates to allow for but annual changes to build out probabilities, so estimating the time series for them. So the Europe results are forthcoming as a working paper, and of course the 2012, 2011, 2012 time period plays a bigger role there. Yeah.
And Halem has her hand raised. I don't know if that's up from earlier. Halem, do you have another question?
No, I think that's from earlier.
Okay. I got a question sent to me also, which is, To Anche, does the analysis include any exploration of the factors that changed investors' minds about the probability of being bailed out?
No, not at the moment. We just write down a structural model that's sort of recursive, because if the bank gets bailed out, it lives on, and bailout could happen again. Government intervention could repeat itself, and take that model and fit it to the data. So at the moment, we are not providing the story. I mean, we cite certain newspaper article around the time of Lehman's default and the years thereafter, that sort of, in the spirit of the bailout that wasn't. So that expresses some surprise in terms of investors' beliefs about government support of large financial institutions. But there is no explicit exploration right now into, or survey or questioning of folks of what may have changed their mind. We did, or not me, but Daryl gave a seminar, I believe, a year ago or so, where there was a very large audience and of market participants, academics, I think a couple hundred folks, and he asked them what their current beliefs about bailout probabilities were, and sort of the median of the folks surveyed there was still at 80%. So that's kind of, a long time after, and not looking for explanations of these beliefs, but people answered very quickly and still had very high beliefs on government support should a big bank fail.
Great. We have time for one more question, it looks like. I see George has his hand raised. George, you want to finish up the questions?
Sure. So I have a question for Hans. I was wondering, so you used 1 year before and 1 year after. I was wondering to what extent the law change was anticipated, if there were discussions about it beforehand, and how that might impact the results. And then related to that question, I was thinking about firms. I would imagine that some firms might be more flexible than others in terms of shifting between term loans and credit lines. So I would imagine that, firms that were more constrained to use term loans were probably hurt through this law because of what you find in terms of lending. So do you see any shift to credit lines before the law change, for example, and that maybe also would indicate some anticipation of this law change happening?
Oh, yeah, thanks for your question and suggestion. So let's say the time in between the vote in Parliament and the actual implementation was relatively short. So we also looked at, let's say, the discussion, and so there wasn't too much, let's say, time in terms of anticipation. So in terms of, let's say, which firms are affected, so indeed, so some firms are using both types of let's say, are using credit lines and term loans, and indeed, so we find differential effects depending upon, whether they were using term loans only or whether they were using both types of things. And then, so also maybe something that I didn't have time to explain. So what we are having, of course, is, so to some extent, it is a staggered implementation of the law because, it's only in new loans that it is going to be implemented. And so what we are seeing, if you are basically looking, let's say, expanding our window gradually, let's say from immediately after the law, gradually adding additional quarters, what you are seeing is that, let's say the magnitude of the impact seems to increase over time. But these are very good suggestions and things that we need to think further about. So actually, if I may, I also had raised my hand actually, but I'm not sure. Maybe somehow my hand wasn't visible enough. I should probably do like this. So not sure whether there is time, but I had a question for Kun. So very nice paper actually. So I was wondering, maybe you said it, but are you also looking at the role of technology? Let's say the technology that the different customers are using, because running on a bank may be much easier if you're basically using, let's say, a more advanced technology. And so I'm not sure whether you're having data on that. Thank you.
That's a great question, Hans. We do have in the paper some interactions one of the things we know is whether the bank uses already e-banking or not. But of course, you have to remember in 2008, that was a very limited set of people. So now that would probably be much bigger. But we do, in the paper, we do have controls for the scope of the bank. So whether this guy is savvy, also have investment credits, or only just has a deposit account, whether they have insurance with the bank. So we control for all that kind of thing. We don't show it in the main results, but especially with the idea of e-banking, because that could be related to switching costs in a way. If I understand your question, it's about the switching cost, right? So exactly. We do see, one of the things we do have in the paper at the moment is people that have their income at the bank and basically do all their payments and have their like permanent payment orders, they are a lot less likely to run. And that also relates to the switching cost argument. So in that sense that we have, but you could try to separate out the guys that already at that time used the internet. So thanks for the question. I will do that. Yeah.
All right. With that, I think we are out of time. I appreciate all of our wonderful presenters today. Thank you so much for joining us from all around the world at your various very unfortunate hours. We look forward to welcoming everyone back tomorrow morning at 9:15 Eastern Standard Time, where the chairman is going to provide some opening remarks, and then we'll move into sessions for the day. Thank you again for all the speakers, and thank you for the audience for your attendance. Have a good evening.
Thank you.
Or morning.
Thank you.
Thank you all.